Today I'm opening a stocks and shares ISA with stockbroker AJ Bell and looking at 3 ways of investing £1,000. Hi, I'm Marcus De Silva and I've spent 15 years in the city interviewing lots of different professional investors. And what I often get asked is, what would I do if I was starting out again, opening an ISA and investing my first £1,000? Today, we're going to open a stocks and shares ISA at AJ Bell and then look at 3 different ways of investing that first £1,000, from the easy peasy, very hands off, through to the DIY, let's construct a diversified portfolio of investments. Just one thing to note, none of the funds that I mentioned are recommendations. Okay, we're going to start with some investing. First thing, make sure you put some cash aside. Investments can fall in value. And if you've got an emergency and really need the cash, what you don't want to be doing is selling those investments at the worst possible time, because markets will go through periods of time where they're good, others where they're not so good. So make sure you've always got some cash savings. 3 to 6 months of living expenses is a good idea. Number 2, find a broker. There's the really simple investing apps, which basically just get you to click how much risk you want to take, and then they put you in big, broad funds. Nothing wrong with those, but it doesn't get more complex than that. What I've gone for, and what you can see here on the screen, is one of the old style DIY established brokers, AJ Bell, Interact Investor, Hargreaves Lansdown. These are the big players within the market, and they've just got loads of stuff basically, which means that they've got all the accounts that I kind of want, all the investment products that I kind of want. It's a full fat, all under one roof kind of service, which is why I've gone for them. Other things to look out for, does it have some extras that you might want? This has got some tools for picking funds. They're really useful for some inspiration. Clearly, it's liked by its customers. It's also got some good content, so some good guides here to sort of help you along and learn a bit more about investing, and Shares Magazine as well, which I quite like. And it's got some good experts at the platform that we've had on the podcast before. Laith Callith, the investing expert, and Ryan Hughes, who is the funds expert. Check them out on the YouTube channel. So look out for a few things like that. I think the final thing as well is cost. They do vary in cost. AJ Bell has a pretty cheap ISA, which is what we're going to take a look at. So make sure you sort of get into the weeds of the service and how much it's going to cost you. So next, you're going to open an account. And what we're going to look at today is opening a stocks and shares ISA. An ISA is just a financial account which you load with some money and do some investing out of. But it's completely tax-free. It's tax protected, so you won't pay any capital gains or any taxes on any income that you receive. You can put up to £20,000 a year into an ISA each tax year. That's your limit, but that will cover most of us, I think. We're not going to be investing more than that in a single year. And it's very simple to do. So, as I say, when you're looking for ISAs, don't forget to check out the costs. I liked AJ Bell because it's pretty cheap, 0.25% of your assets. So we're investing £1,000 today. That means each year it's going to cost you £2.50 in platform fees to have those investments. Investment fees are a separate thing, but we'll get onto those in a sec when we have a look at some of the investments. So, found your ISA, you then just go about opening one. It's actually very easy to do. You need a few different details in order to do it. You'll then fill out your name and different details here, put in your bank details and fund it with some cash. And, hey presto, you'll have an ISA open. Okay, ISA is open. I put £4,000 into it, basically. I've already made some investments. So what I'm left with is about 2,200 in cash, and I'm going to invest 1,000 of that money into some funds. So how do you go about finding some investments if this is the first £1,000 that you are investing? Well, what we're going to do is go through 3 different routes that sort of increase slightly in complexity. And this is what's great about AJ Bell. They have these different tools that really, really help you select some funds. And where we're going to start is their own funds. Okay. Now, what these are exactly the same as the type of portfolios that you would find at the apps, at the Do It With Me brokers. What you do with them is you make some simple decisions about how much risk you want to take, and then they'll put you into a portfolio that invests in lots of different trackers, which means they're very cheap. So a tracker is a fund. So a fund just contains lots of different shares of different companies. And what a tracker will do is replicate whichever market that it's designed to track. So in the UK, we have the FTSE 100, which is the largest 100 companies in the UK. And what a FTSE 100 tracker would do is just buy exactly the same amount of companies in exactly the same proportions that you'd find on the London Stock Exchange. So that is a tracker. They're also called ETFs as well, exchange traded funds. So we'll see that referenced here as well. There's no investment manager that's selecting stocks, which is why they're very cheap and why they're a good part of any person's portfolio. The other route that you have with funds are what we call active funds. So that's a passive fund. An active fund will have a fund manager, a portfolio manager, a stock picker, an investor. They come by lots of different names. And what they will do is pick stocks out of a particular market that they think are really, really good. So a fund that is investing in FTSE 100 companies, you might have a fund manager that selects 50 out of those 100 that they think are really, really good, and then put them into the portfolio. So you've got this professional that's overseeing basically the investments of that particular fund. Now it sounds good, right? It is, but it comes at a cost, unfortunately, and also the other thing is they don't always tend to pick the very best companies. So that's the downside a little bit. And why you really need to blend those, but we'll get into that in a little bit. We're going to start off with these funds then. So as I say, the great thing about these is that they're cheap because they're full of passives and they're very, very diversified, and there's not many of them. In order to do some investing and decide what's kind of best for you, you're going to be given a few different choices. What do you want out of your investment? Do you just want to grow the value of your investment? So that £1,000, you just really want to grow it as much as possible? Or do you want to get some income out of it, maybe give up a bit of that growth, but for it to kick out some income? So if it's a bond, it will kick out some interest. If it's investing in shares, that fund, it will kick out what they call dividends. So you've got to make that decision between what you're kind of after. They've got this responsible portfolio as well. So responsible investing is something that's grown massively in recent years. And it's only going to have passives that invest in companies that meet certain criteria that show that it's a responsible company. So, for example, how much pollution maybe it puts into the atmosphere. So you've got a few different choices there. With my £1,000, well, I'm just thinking about growing that. So I'm perfectly happy with that portfolio. What comes next then is how much risk you want to take, least risk all the way up to the most risk. And how does this change what you invest in? Well, the key asset classes, the main investment groups are either the shares of companies, little pieces of ownership of companies, or bonds, which are basically IOUs. They're issued either by a company or a government. And what that company, that entity will do is say, right, I want to borrow 100 quid. So I'm going to borrow it off you, the investor, and every year I'm going to pay you a rate of interest, let's say 5 quid every year. And then after 10 years, I'll give you 100 quid back. That's what a bond is. Government bonds are safer than company bonds. You can kind of imagine why. The UK government is clearly going to be more reliable in paying its debt than an individual company would. And shares are basically the risky group of investments. Bonds are the less risky group. So the main way in which they adjust these underlying investments is if you want to take not so much risk, we'll put more bonds. They're also called fixed income, by the way, which is why it's labeled that here. Bonds, fixed income, fixed interest. You'll hear a few different names for it, but that's what they are. So you can see the most cautious profile here has a fair bit of bonds. The more risky one has just shares, mainly shares. So that's how they change the risk within these portfolios. How much risk do you want to take? What's appropriate for yourself? Well, there's two ways of thinking about this. The first thing is how far away your goals are. Generally, the guidance is you shouldn't invest in shares if you want to get that money back within 5 years. So you need longer than 5 years for shares. But really, ideally 10 years longer. The longer you leave it, the more reward you're going to reap from investing in shares. So that's one way of thinking about it. How far away are your goals? The second way is just how much risk you're prepared to take. Some of us are adrenaline junkie, risk junkies. Others of us want that security with our money. We don't like the idea that it could potentially fall in value even for short periods of time. So combine those two things, and that's how you kind of think how much risk you want to take. Now, my goal is 10 years away. I like a bit of risk, so I'm probably going to go for this growth portfolio. And I'll just quickly show you how the differences in how these change. So if we click on that, what we can see here is their cautious fund here. That's the underlying charge, the ongoing charges figure there. So always good to check that out. That's very low. And that's because, as I said, it's investing in passives. And what this shows you is how it's allocating to different assets to achieve that lower risk profile. Here is the scale of risk from 1 to 10, and you can see it's down here at 3, so it's a lower risk investment. So you can see that's what they're kind of targeting there. And these are the assets within the portfolio, and we can see the shares here only represent 22% of that whole portfolio. Bonds represent 55%. So that's why this is, it's got a lot more bonds in it. That's why this is lower risk. There are other assets that you can invest in that we would label alternative, things, like property or infrastructure or commodities or currencies. There are a few different things that fall into that bucket, but the main ones that you kind of think about are shares and bonds. This also being a lower risk portfolio has quite a bit of cash in there as well. So that's what you're getting when you sort of select something like this. How does that work out? Well, here are all the underlying funds that it invests in. So if you put £1,000 in here, then £180 would be in cash, £140 would be in this bond fund. That's basically safer investment grade, means a slightly safer form of bond. And these are all the trackers that are in there. Basically, this is the biggest 500 companies in the US. This is bonds of companies. These are slightly more risky bonds. There's some emerging markets there, so maybe from places like China and India and etc. So that's what you get within this portfolio. Let's move up to someone who's a bit more adventurous. So we'll go for a real out and out growth portfolio, and what we can see in the allocation here, so there's the risk rating it's been given, 8 out of 10, so clearly a lot higher, a lot more risk. And there we go, we've got 88% is in shares, you see, and there's actually very few bonds. 7% is in bonds. So that's how they kind of adjust the risk within these portfolios, really. And underlying holdings, again, you can see them all in here too. So this is, and then you just, click invest and get going, and you'll hold all of those. What's the advantage of this? Well, I think it's really low cost. It's a one-stop shop. The expert people like Ryan are the ones who are thinking about all the investments that go into this. So you've kind of got a professional allocator on the top. Simple, just get going. The slight criticism might be that because you've got an awful lot of trackers which are very broad, you're holding, within those, you've got 500 shares within that particular passive there. So it means in total, your investments are in, thousands of underlying investments. So that might be what we say is over diversified. That could be leveled against this. But it's a really good starting point, a really good hands-off way of investing. And as I say, you'd get this at the at the do it with me kind of investing apps as well. So that's the first idea. Next, what we're going to go to is, and slightly increase a little bit of the interest, a bit of the complexity, is to go to their ready-made portfolios. Now, what these ready-made portfolios, how they differ is, rather than it being a fund of funds that sit underneath it, this is a list of funds in which you can invest. So it's a tool of providing you with some, a list of funds that they really like. So they come out of their preferred list. So Ryan, after his 20 years of interviewing different fund managers and different companies, has got this list of funds that he really, really likes, managers that he thinks are good, the process is good. So they kind of have this preferred list, and you can find it here, actually. If you just want to look at those kind of lists, then you'll find it right here. Sorry, it's also under here as well, under favorite funds, basically. So out of their favorite funds, this is a tool for giving you a selection of those that is appropriate to what you're trying to achieve. So it's got different ideas based on how much risk you want to take, similar to before, plus also if you're seeking income. And then what you do is you just type in the amount of money that you want to invest. So we're doing £1,000, click submit, and it returns back to you a list of different preferred funds in the different amounts in order to give you a nice diversified portfolio of funds to invest in. So because we've gone for a more adventurous approach, then what it's allocating you into is a lot of funds that have shares, some bonds, just to balance things out a little bit, in order to give you this kind of 7 out of 10 profile. And in order to achieve that kind of allocation, these are the funds that it suggests that you invest in, because so 85%. Shares, or mainly shares. There's only one bond fund in there, basically, and that to get that 10% of bonds. So that's how you then achieve that kind of level of risk. So it's a really clever way of getting you going with some of your own funds, which you can then add to, change, find new ones, over time. This is just a bit of a starting point. So I think it's a really great tool for that reason. So that's the second kind of idea. The third is, the most involved in terms of investing, and that's to construct your own portfolio that's diversified as well, that sort of gets you going with thinking about the types of investments that you might want. So we're going to have a little look at that as well. So go up to just the favorite funds list as a bit of a starting point, and a way of describing to you how through these kind of different ways of filtering out different investments, how you might create a portfolio that's diversified. Diversification is, it's one of those things that actually sometimes people can get wrong. Sometimes they buy too many funds from the same market because they're invested in the same companies, these funds, or similar companies. Then you can end up duplicating investments, layering them up, and therefore not really diversifying properly. The other is diversification, just too many funds, which means that, underlying investments, you have thousands of underlying investments. So there's a couple of tips that I can give you for just making sure that you diversify properly. The first tip is to geographically diversify. That seems sort of a bit more obvious. Different economies go through different problems at different times. So to reduce the sort of individual economy risks and the companies within them, then what you can do is to make sure your investments are sort of planted all over the world. Now, you could do that by rooting around in different country sectors and picking funds from the UK, Europe, North America, Asia, some in emerging markets, not just the developed markets like the US and the UK. You can look at emerging markets like India and Indonesia and places like that. So there are a number of different ways in which you can geographically diversify to keep it easy, going for a global portfolio that, its remit is, shares from all around the world. That kind of makes it easy. That ensures that you've kind of got that global diversification. I would chuck some investment trusts into the mix that are quite well, that invest in lots of different companies around the world and got a real pedigree of history. F&C was launched in 1868. I think it's the oldest fund in the world. It's pretty big and it's pretty cheap and pretty well respected. Alliance Trust is very similar in that respect. 1888. I do a lot of work with Alliance Trust. They have quite an unusual setup with 10 different teams that do all sorts of different things around the world that are providing stocks into the portfolio. Again, pretty big, and bankers as well. I've done some work with Alex Crook, who runs this trust as well. And again, another great trust. So some ideas there. So geographical diversification, number one. Number two, get in some trackers as well as active. Those three investment trusts that I mentioned, have a fund manager that picks stocks. What you can do but what can happen with a particular fund with a fund manager is they can go through periods of times where they're not picking great stocks, and the benchmark to which they're compared, they underperform that benchmark. So in order to diversify out some of those manager risks and the risks that you have in an individual product like an investment trust like F&C, is to put in a tracker as well that does the same thing. So you could pick a tracker that invests, like this one, that invests in shares around the world too. And whilst all you're ever going to get is that benchmark performance, because effectively is the benchmark, you're not going to underperform either. So that, again, provides you some manager diversification, but also blends a lower fee. So if you're investing in F&C, you'll then, rather than putting, all of that world investment into F&C, you're putting half in F&C and half in a tracker, then you're going to get that blended cost, which is lower. So that's another advantage of incorporating trackers with active. So that's number two. Number three, you don't want to be invested in just one asset. And any of those multi-asset portfolios, as you saw, always had bonds in as well as shares. And of course, as I mentioned, it's a way of turning down the risk because shares are riskier than bonds, and bonds will perform differently. They'll react differently in certain market conditions than shares. So by having the two in there, when things are not going so well and stock markets are tanking, then bonds tend to do a bit better there because they're a bit more of a safer asset. They call it a safe haven asset. So, the money tends to switch into there and they tend to do a bit better. So it's why it's good to blend that portfolio with some bonds. And if you're a bit more risk averse, have more bonds in there and less shares, like you saw in the multi-asset portfolios. Out of them, there's a few different ways of looking at it. Emerging market bonds are going to be more risky than developed market. High yield bonds are going to be more risky than what they call investment grade. I would go for a strategic bond fund. You do whatever you like, but strategic bond funds are quite nice because they will just invest anywhere in the bond market, basically, in any of those different kind of classes of bonds, whether it's government bonds, corporate bonds, high yield, whatever it is. So one idea might be, Artemis Strategic Bond is quite a well-respected bond fund there. Also, Allianz as well has a good bond team too. So add in some bonds. That's the third kind of idea. What's my fourth and final idea is get in some smaller companies as well. Perhaps think about some different assets. With this final bit, you can actually have a bit more fun. So you could just, sort of maybe invest in some smaller companies. They're a bit riskier than larger companies. So, these trusts will have larger companies in them. You could go for, a smaller company fund, which, involves a bit more risk generally with smaller companies, but with more risk comes more return. So that can be quite good. Or you can do some other kind of more esoteric, sexier stuff. There's this approach called core and satellite. And it's, put the majority of your portfolio in sensible, diversified investments. And then around the outside, so that's your core, around the outside, have some satellite investments in sexy, interesting stuff. Your individual shares, your alternatives, your weird and wonderful kind of investments to have a bit more fun. So it's a well-known strategy. Look it up, core and satellite. So you could say, well, my satellites are going to be smaller companies, or I might go even riskier. I might come up to the share screener and actually start having a little look for some individual shares. Be warned, they're very risky. Or you could go for some funds that are a bit more unusual. I've picked out here a couple of hedge funds. So this is Pershing Square. The guy that runs this is a chap called Bill Ackman, and he's a very well-respected hedge fund manager, trained by Warren Buffett. So this is quite a risky product. It tends to have very few. Hedge funds tend to have very few positions. So rather than 50 or 60 or 100, they have, say, like 15. So that is a sort of riskier thing that you might do. This is another one. You could go for something that's really specific in the market. So this is sort of investing around technology and IT kind of shares, sort of like interesting parts of the market like that. The other one is private equity here. So 3i, it's a well-known private equity fund. It also invests in some infrastructure as well. 3i also have an infrastructure fund specifically. So those are kind of like, they're risky, be warned. But that can be one way of investing in those things without worrying too much that your investments are going to tank and really fall off a cliff, because you've got that core of investments in stuff that's a little bit safer. So that would be my kind of 4 kind of ideas of maybe diversifying your portfolio if you wanted to start out. Okay, now go and buy some investments for your ISA and let me know how you get on. For more tutorials and investment education, go to the Steps to Investing YouTube channel.